All right, guys, I guess we'll go ahead and get started. It's 1:59, so by the time I get done introducing all of us, we'll be ready to roll at 2 o'clock. I'm Stephanie Taylor. I'm the sales director here at Crowe and Associates. Today we have with us Mark and Greg from Pinnacle Financial Services. They are the life and annuity team for Pinnacle, and they handle all the business. They can help you with quotes. They can help you with all sorts of stuff. These guys are amazing. So we have them here to do a little presentation for us today about annuity basics. We did one a couple weeks ago about life insurance basics, and we're going to try to have them come on once a month or so just to kind of do a series to help everybody get familiar with these types of products. Not everybody is selling life and annuity right now, mostly probably because you're afraid of it. But these guys are going to help break it down so it's not so tough to tackle. So, Greg, thank you so much for coming today. I'm going to go ahead and give you permission to share your screen for the presentation, okay?
Perfect. Yes.
All righty, hang on. There you go, sir. I see your presentation.
All right. Perfect. Thank you
Perfect.
so much.
Yes.
Yeah.
Thanks for coming on. We appreciate it.
Yeah. No problem. As Stephanie said, yeah, I am Greg Yotis. I'm the senior sales director here for life and annuities. So today we are going to be covering annuities. Our presentation's just titled Annuity 101, but this is basically, the first step in just understanding the basics of the annuities we offer, how to position them, those kind of things. I am also joined by Mark Bolger, who's our client specialist and also involved with running proposals for the annuities and life insurance. So with that, we'll get started. We are, like I said, we are your specific contacts for life and annuities. So if you have any questions, we always like to joke, we're here to help you from submission to commission. So we can answer any questions about the products, case design, sales ideas, anything that you really need to know or want to know about. We're here, we're available. You see my contact and Mark's contact information there. Don't hesitate to reach out. We also, just like these calls, we have various calls throughout the month here that we record, and you can actually utilize that through the Pinnacle site. So really anything you need, we have you covered as far as getting the business submitted. So, one of the things about annuities, and I apologize if some of this is a little bit very, very basic, but I think it's important, especially when you're dealing with the annuities, to understand kind of the whole picture before you dive into doing it. Or even if you're, have been doing it, the more you can understand some of the basics, the easier it is when you're talking to a client. So, one of the things I like to start out with is, why are annuities important? And what you see there is, Americans are living longer these days, right? Retirement planning is essential, as we all know, and we are in the midst of probably the biggest wealth transfer in our country's history, with the amount of baby boomers that are retiring, people just retiring, and that how that money is being basically spent towards retirement, and then how that is transferring to other generations. So there's a lot in play here with the annuities. And one thing about the annuities, unlike any other financial product you can basically offer, it does allow for guarantees. It's the only product you can get guarantees, with guaranteed lifetime income. The benefit of an annuity is the peace of mind knowing that you have those guarantees and the security that it brings. So just wanted to, highlight that. Again, just reinforcing the importance and why people need to be looking at annuities, or why you want to offer annuities. 95% of retirement savers agree it's important for a financial plan in retirement, right? Everyone gets to that point, whether if they started early or if they're starting late. When you get to that point and you're closing in on retirement, you need to have a plan together, and that's what we do. We, as agents, we're we're there to give them a plan and an option to satisfy what they're looking to do in retirement, or whatever their scenario is, help them through it. So 81% of the retirement savers report they're concerned about having enough savings to last for retirement, and that's important, right? Because unfortunately, not everyone in the U.S. does a great job of saving for retirement. So, to have a plan, like I said, and being able to kind of solve some issues that people have, annuities are a great way to actually do that. So, and then finally, 54% of the savers report that today's economy, they are considering some time of guaranteed lifetime income, and which is like pays like a pension. I will say I am a big supporter of lifetime income. I just feel like with people living longer, to have that guarantee, and as we all know, pensions, there's not many professions that actually offer pensions these days. So I always say using an annuity with a guaranteed lifetime income rider is like giving yourself a personal pension. It's money that you can't outlive, and you don't have to worry that one day it's not going to be there for you. So when you compare that with either a regular 401k or an IRA that has market volatility, there's no guarantee based on the performance of those underlying assets that money is going to be there for your full retirement. So annuities are the one way to make sure that it is going to be there. So it brings us into the types of annuities that Pinnacle offers. We have which most commonly called SPIAs, but that stands for Single Premium Immediate Annuities. And we'll go into some of the specifics of those. We have fixed annuities, which I would say is very closely related to the SPIA, just without the income aspect of it. We have what are called MIGAs, or multi-year guaranteed annuities. Easiest way to explain those, and we'll get into that, but it's really like a CD alternative. They're going to pay you a specific rate of return for each year for a specific number of years. And then we have the fixed indexed annuities. And those are going to be where your underlying assets are tied to an index, but still have some of those guarantees. So those are the four basic annuities that we offer. SPIAs, by definition, it's a one-time purchase payment, and basically that's going to provide regular, premium payments or income payments over a specific time frame. So a lot of options there. With how you receive that money, you can specify a period certain. So if you just wanted to receive the income for 10 years, you can do that. You can receive it for a lifetime. If you wanted to receive it for 20 years, that income payment, you can do that. And we'll get into some of the advantages and disadvantages of the SPIA. So the SPIA, it's easy to understand. It's like I said, it's a one-time premium in there, so we'll just use easy numbers for today, so it's easy to understand. You have $100,000, and you put that $100,000 in to the SPIA, and then at a certain point within the first year, you're going to start receiving income payments based off of that $100,000. And like I said, you can design it where it's either lasts for, a 10-year period, 20-year period, and in some cases, lifetime. So very good as far as, having that income and knowing exactly what it's going to be. There's guaranteed long-term payments, like I said, with the lifetime. Those payments are not going to fluctuate, right? So they're going to stay the same every year, no matter what, all the way through. There's some lower fees in regards to that. There's no fees involved in necessarily a SPIA. It's all included inside of the product. And it does offer some, inflation protection, because you are getting a specific return on your underlying asset that is then turning that and the principal into a lifetime or period certain income. So some of the disadvantages of this SPIA, the single premium immediate annuity, is lower liquidity. So as the example we used with the $100,000, when you turn that over to the insurance or the annuity carrier, you are only going to be entitled to that string of income payments going forward. So you really lose access to your underlining, 100,000 that you put in there, your principal. So the SPIAs don't necessarily make sense in every situation. What we see in a lot of cases is, if person is only concerned about that income and generating as high an income as possible, it makes sense. They don't need it access to the other, to the principal. And also, if they have other assets that they can tap into, the SPIA may make sense. But that illiquidity, I'll call it, disadvantage is one thing to be very concerned of. No upfront costs, or large upfront costs, because everything is built into the product. There's minimal returns inside of that, so it gives you a little bit of inflation risk, because when you purchase that SPIA, everything stays as is based on the interest rates at the time. So if interest rates actually increase over the years, you get a little bit of inflation risk. It's going to offer a little bit smaller inheritance to your beneficiaries, depending on what option you take, because they're only going to be basically entitled, your beneficiaries, to whatever's still remaining that you haven't taken in income, based on your principal. So, you can exhaust that inheritance and have basically a zero principal left by the time the SPIA is done paying the income. And then market risk, like I said, it's not a variable product, so it's very stagnant in as far as what the rates are when you actually purchase the SPIA. And I'll just, if anyone has any questions, feel free to ask them. You can type them in the chat, or if there's something you want me to go over, please do so. So the next one up the annuity ring is the fixed annuities, which allow you to lock in a rate and earn that over a period of time. Basically, again, it's protecting your principal. There's no market fluctuations, no ups and downs in your principal. Principal stays the same. You're just getting that specific rate of return that's guaranteed to you when you purchase it. So, there's no income with these fixed annuities. It's just basically an accumulation play, nice, safe accumulation play, with getting that specific rate of return. So fixed annuities, the advantages of those, like all annuities, tax deferral, right? You don't pay any taxes until you actually take a distribution or move that money out of the annuity. Your advantages, like I said, the principal and interest are protected, are locked in. You're not going to lose any money. Again, with no market risk. A little bit of flexibility. You can move those pretty easily to another option or another annuity option. Generally there's no fees to go into a fixed annuity, maybe just a surrender schedule for a short period of time. And then it gives you, beneficiary protection. Like I said, if you're looking to, in a situation where you're looking to pass on that money to your beneficiaries, the principal is going to be there in full based on what you put in there. And that's what's going to be available for the beneficiaries. So it offers that safety. Some disadvantages for the fixed annuities, there's less opportunity for growth, right? You're going to get a lower interest rate. So say, for instance, just using an example, say you get, a fixed annuity and it's going to pay you 3% a year every year you're in there until the interest rates change. So it could fluctuate between 3 and 4, but generally it's going to be a lower rate of return. So you lose some opportunity of growth there. Those rates do change, so there's some inconsistency with the rates. They're going to go up and down based off of interest rates. And then, because those are tied to the interest rates and it's a lower growth opportunity, as inflation increases, you could be, on the negative end of the inflation if you're not getting a high enough return in those products. So we don't see a ton of these days because there's a lot of other options, but just wanted to highlight what the fixed annuity is about. And now we get into the multi-year guarantee. And I'm sorry, I'm getting some feedback in the background there. I don't know if somebody's not on mute, but.
Nope, everybody's muted.
Okay.
I didn't hear anything.
Sorry about that.
It's Mark.
That's okay. That's okay.
So
I hope you can hear.
yeah, that cleared it up. So the multi-year guaranteed annuity, it's going to be fixed, and this is one of the more popular ones. It is considered a fixed annuity with a fixed interest rate. So basically, the difference is where the fixed annuity, that interest rate can change year after year. With the MYGAs, you're going to get that same rate for a specific guarantee period. So to give you an example, if you did a 5-year multi-year guaranteed annuity and you're receiving a 5% rate of return, that means that you're going to get a 5% return each year for 5 years. And then at the end of that 5-year period, it's going to reset based on interest rates. And you have the option to either continue with the new 5-year rate, whether that's, goes down to 4% or it goes up to 6%, or you can do what's called a 1035 exchange and exchange that into a completely different annuity. 1035 exchanges are not a taxable event, so you can go from annuity to annuity and not have to pay any type of taxes on that, no matter what your gains are. Like I said, the only time you pay any taxes, whether it's qualified or non-qualified annuities, is when you take the money out of the annuity as a distribution. So advantages to the MYGA, again, tax deferral, which is always a benefit for the annuities. It makes a lot of sense for people who are, in the higher tax brackets and are worried about deferring taxes. Principal and interest is protected. Like I said, there's no market risk. So no matter what the stock market does, if it goes down 30%, up 30%, your money's not affected in these because it's not tied to the markets. It does give you some flexibility to, what I'll say is a common way that a lot of people use the MYGA is they'll do what's called a laddering strategy. So, excuse me, they may actually buy it like a 3-year MYGA for a portion of it and have that locked in at, say, a 4.75% guaranteed rate. They'll buy a 5-year that's maybe offering 5% for 5 years, and then maybe a 6-year as well. That's maybe offering 5.25% for 6 years, and then that way it's kind of laddered. So every so often when these come to maturity, they're re-upping at the new interest rates, and it kind of is a way to diversify that interest rate risk. So that's a little bit more of an advanced concept, but it's definitely something that works well for the MYGAs. With the MYGAs, it's going to be ideal candidate is going to be somebody who is very conservative, wants a guarantee, wants to know exactly what they're going to get, absolutely wants that principal protection. And really, like I said, I think earlier, the MYGA is the easiest way to think of it. If you're familiar with CDs, it's a CD alternative, so it works similar to a CD, but the MYGAs generally have better guaranteed rates than CDs do. So any clients that you run into that does have any kind of bank CDs, a MYGA would be a great option to get them a better rate of return. And the reason is that the carriers can offer better rates than the banks, because the banks are a lot more conservative with the rates they offer. So that's one of the big benefits of the MYGA, and where we see a lot of the business flowing either for that really conservative money that they want to invest, or if they have old CDs and they want to roll those over into MYGAs and get a better rate of return. Some disadvantages, again, because of the interest rates, and like I said, when you're looking at a guaranteed rate of 5%, and if you're just comparing that against an S&P 500, and the S&P 500 index did 10% that year, you're not gonna grow as fast as if you were invested in something that was tied to the S&P. a little bit of inconsistency with the rates. Like I said, it's at the end of the guarantee period. Those reset based on interest rates. So, they could be higher or lower, but you're not too sure until you get to the end of that guarantee period where those rates are gonna fall for rolling that into another multi-year guaranteed annuity. Um, and because those are a little bit lower guaranteed rates, like anything else, because you're not taking on any type of risk. If inflation is high, that does eat away at the returns that you'd see. So that's a negative as well, or a disadvantage of those. But I think the main thing to remember with the MIGAs are going to be for people who are very conservative, want to protect that principal, and make sure they're not so worried about, growing it a ton. They just want to get guaranteed rates of return that they know they're guaranteed to get and sleep well at night. So, and then finally, that brings us to our fixed indexed annuities, which, again, like all the annuities, they pretty much work the same. But now with the fixed indexed annuities, those are going to be, based off of an index. The performance is going to be somewhat like, it's going to be tied to the S&P. Some of the common ones you see, S&P, NASDAQ, those indexes, again, giving you the downside protection. So you're never going to be able to lose money in these because of the guarantees that are offered. You can only go up. You won't lose your principal. So it's going to protect you against losses. So anyone who, I always say annuities are a great option for anyone who is closing in on retirement, or in the beginning stages of retirement. And the reason being, as we see the volatility in the market, if you're a few years out from retiring or in the beginning stages of retirement and your money is tied to something that's variable, that means it can go up unlimited and down unlimited. If you have a 30% pullback in the market or whatever you're invested in, you don't have enough time to really make that money up if you're getting ready to retire. So it's very important to kind of protect that principal when you're getting close to retirement and kind of take those unexpected downturns out of the equation. So that's one of the most important things with annuities as a whole, but specifically, you look at the fixed index annuities because most people are coming from some sort of variable account when they're going into the fixed indexed annuity. So advantages of a fixed index annuity, you're going to limit your losses, of course, because you have that downside protection. You're only going to gain money, and then possible guarantees on your earnings. So, there's a lot of different things with the fixed index annuities. It's a little bit more complicated of a product, and we're going to go into some of those bells and whistles that it has. But those guarantees in your earnings, they can offer you that no other product can. You have some inflation protection because now you're tied to the index, so you're going to get higher rates, possible rates of return, so you can keep ahead of inflation costs. And then, of course, the tax deferral growth, so you're not paying any taxes until you start withdrawing money out of the annuity. Disadvantages, like with any of these, because you have that downside protection, you're giving up some potential upside gains. So if the S&P does 10% or 20%, you may only receive 10% of that upside, but that's because they're paying for that downside protection. You do have some fees involved as far as surrender fees. I would just say this, in most cases, annuities are a long-term option or investment. So the surrender fees should never be a hindrance because the person who's putting their money into an annuity should understand it's a long-term investment and it's not something that they should change their mind about a year later. So, but there is some fees involved with the surrender charges. And then, some return uncertainty because now you're not getting a guaranteed rate of return. Your return is based on the performance of those indexes. So, and we'll take a look at how some of those index segments work and how that affects the performance of your underlying assets. So some of the key terms to understand for the fixed indexed annuity, you're going to, and each carrier may call it a little bit different, but these are going to be ways that they limit the gains or the losses. So a loss floor, basically just means that 0% floor. So if the index does a negative 10% that year, the S&P is negative, your return is going to be zero. So you're never going to have a negative return. So that's the floor for these products. Minimum returns, sometimes they're going to pay a small guarantee. What we see most common, the fixed index annuities have kind of a fixed bucket. So if you wanted to just get a, fixed rate of return for that year based on what rates are, most of those are around 4%. So you're going to get a small guarantee interest rate on that, and that's usually your minimum return. Adjusted values, that's going to be basically with the returns of the indexes. They're going to adjust those periodically for either a minimum value for the contract or, it locks in gains and you cannot fall below. So think of it this way: if you put in 100,000 and you have a $5,000 gain in there, that adjusted value would now your floor would go from 100,000 to 105,000. So it kind of locks in those gains for you. A return cap, or most commonly called caps, I mean, that's basically when you are tied to an S&P, just use that as an example, and the cap is set at 10%, just simply means that if the index has a return of 20%, you're just going to receive 10%. If the index has a return of 8%, you're going to receive 8%. So the certainty there is that they know that they're going to get somewhere between a 0% return and a 10% return based on the performance of the S&P 500 or the index segment that they're in. The other most common index basically segment crediting option is participation rates. So, basically you're going to have a participation rate tied to that index return. So I think we have an example here. If the participation rate is set at 50%, you're going to receive half of what the index's return is. So if the index did an 8% return, you're only going to receive, 4% of the return. So that's for some, options, because the participation rate, if you feel like the index is going to have a really good return, in a lot of cases it allows you to get a higher rate of return than you would with the cap. The cap gives you a little bit more steady return options, where the participation rate lets you get a little bit higher if those indexes outperform. Now, in the 50% is probably not a great example. Most participation rates we see these days are either there's a lot of 80%. There's even ones that are 100% participation rate, and there's options as well that are over 100%. That you can have a participation rate tied to that index. So really allows you to kind of capitalize on higher index returns when you're in those segments. And then, which we don't see a lot, in a lot of cases, you may see spreads, margins, asset fees. Sometimes those spreads are, simply like if it's a 1% spread, it's saying that, hey, if the index had a 10% return and there's a 1% spread, the client would receive a 9% return. Same thing with the margin. It's just another way of saying it. If there's a 1% margin, they're just going to take that off of the index return. And same thing with the asset fee. So kind of interchangeable language there. Spreads, margins, asset fees, they all do the same thing, where they lower the return of the index. But it allows you to really capitalize on those years where the index overperforms. And then finally, with the fixed index annuities, the really nice thing about them, and when we talk about guaranteed lifetime income, you can put riders on these fixed index annuity products and take a lifetime guaranteed income. And basically, there's a lot of options. It really helps you in a lot of cases expand, and we'll have other calls where we talk specifically about products. But for instance, we have a nationwide Peak 10 product, which is a really strong product. And when you have the rider on there, it's going to give you a 20% bonus to your income benefit, and then an 8% roll up for the first 10 years or until you start the income. So it really allows you to get that higher income benefit option than you would in any other asset. So with the income riders, always think of it this way: you have two sets of buckets of money. You have your cash value, which is tied to the performance of those indexes, and then you have a bucket which is your income benefit. Carriers may call it something else, but basically that is where your income is based off of that number. So the higher that number is, the higher your income is going to be. And then finally, to help you with quoting some of these and submitting cases, and we'll go into a little bit deeper on another call, but we have quoting software, so we can actually run quotes for you and run those illustrations right from the carrier's websites. We also offer Firelight, which is a e-application system for annuities, so you can actually do everything electronically instead of actually getting the paper forms and filling those out. Anyone knows if they've ever done an annuity app, the annuity apps are quite long. There's a lot of information that's asked. So if you can do it as an e-app, it definitely makes it a lot easier, especially if you have a client who lives kind of far away. Being able to have them sign through a DocuSign option saves you a trip and having to go out to their home again or meet them again. So those are some of the supporting options that we'll get into in another call. And then finally, one thing, everyone asks, especially if you're new to working with annuities, how do I get appointed? What are the options? What do I need to do to start offering annuities? And really, there's just a few things. Of course, if you've never done an annuity before, you need to have your state annuity best interest training completed. So that's the first step. You have to have your updated AML, which most of you do. But those two things need to be current to be able to go ahead and submit an appointment request for the annuities. Annuities are pretty much 99% all pre-appointment. So you do need to be appointed before you can actually write an annuity case with that carrier. If you are not, and we have this once in a while where people either think they are appointed or just go ahead and do an application, you're going to have to do that application. If you're not already appointed, you're going to have to do that application again because the application date needs to be later than when your first appointment for that pre-appointment. So very important to keep that in mind. And then always, the carriers are going to have specific carrier product training that you need to do. And I will go into Reg Ed now and show you, you can use a lot of the different, each carrier may use a different portal. One of the most common one, though, is the Reg Ed site that do those product trainings. And simply, if you're not familiar with Reg Ed, you simply can pull it up. You can Google it, reged.com. If you go to the education and training section here, oh, I'm sorry, not the education and training, the insurance. One second. Trying to look for I'm sorry. So you'll actually go into the annuity training platform inside of Reg Ed. And if you're brand new, you'll actually click on register online. And you can basically fill out your self-registration to get yourself access to Reg Ed. So that's a quick and simple process. As you can see, very simple. You just create a username, a login, email, password. You're going to put in your social security number, date of birth, your national producer number, your address, and you can get access to Reg Ed. And then once you have access to Reg Ed, I'll take you in and kind of show you an example of doing a annuity product training. So you put in your email address and your password. And oh, there we go. And then once you're into the system, basically it's pretty simple. You can go up to the product section here. And if each of the carriers will have a product code for their product. So for instance, we'll take a look, say we were doing the Peak 10. It basically will add that product training down below. And then down below, it'll add based on the carrier, and you can see there's multiple trainings, could be multiple trainings for the different carriers. So once you actually added that, so say for instance we were doing the Peak, you can just proceed to that. I actually already completed the course, so it'll take you through a short little, basically PowerPoint to go through it. Once you're completed it, you'll see your course completion. You can print a record of it. Generally, that goes directly over to the carrier so they know that you have that product training done, but it is a requirement to get appointed before you can submit any kind of business. And it's pretty quick and simple. Shouldn't take you too long to do, just by putting in that product code, adding it to your options down below, and then going through the actual product training. So that is our Annuity 101. I don't know if Mark wanted to add anything that I may have missed. If there's any questions out there.
Yep, there's some questions in the chat box. Mark, right. If you wanted to add something quick before I go through the questions.
I appreciate it. Greg did such a great job. I don't have any questions. I think he pretty much covered everything, but thank you.
Well, it was definitely a great presentation. Lots of good information there. One of the questions is, are there different licenses required to sell different annuity products?
Yes and no. So the only different license that you need would be if you're selling any type of variable annuities. If you're selling variable products, and when I say variable, that means products where you can the principal is not protected, you would need to have those are covered under your FINRA licenses, so your a Series 6 and those type of licenses. We don't offer any type of variable annuities. Everything we offer is fixed. So the only thing you need to license, you need to do the fixed, is your regular state life license, which would include fixed annuities.
Okay, great.
And then of course you just need to then do your annuity best interest training for your state as well, and they can be done through any of the continuing education providers.
Great, cool. Another question: are the fixed annuities a good option for people who cannot qualify for IUL's underwriting?
Yeah, I mean, they definitely could be. Granted, what I would say is, because those are two separate type of products, right? So the IUL is a life insurance product that does have cash value build up in there, but you have a death benefit. If somebody, can't qualify for, the life insurance based on their health, and they just want to concentrate on accumulating that money, they can do it. One of the things I failed to mention with the fixed index annuities, the fixed index annuities, a lot of them, there's a lot of single premium, so kind of like your lump sum, 401k rollovers, IRA rollovers, lump sum products. So you can only basically, just exactly what it says, roll over a lump sum. But there are fixed index annuities what are considered flexible premium. So you can start those with a little bit lower of a minimum amount, so say $5,000 or $10,000, and then continue to contribute to them over the course of the year or years to really build up that cash value. So I would say the fixed indexed annuities would be a better option as an IUL alternative than a guaranteed fixed annuity or multi-year guaranteed annuity, just because you're limiting your upside where you have some higher potential with the indexed annuities because you're tied to the indexes. But the indexes, the way those segments work, they work basically the same as the index options inside of an IUL.
Okay, cool. One more here. Most of my demographic of clients are 55 plus. What would you say is the best choice for them?
I mean, I would say there's not a best choice. It depends on what the goal is. So for 55 plus, I mean, if they have, like I said, any old CDs, if they're very conservative, the multi-year guaranteed annuities are a great option. If they're okay with a little bit of return fluctuation, but want something better than say a 5% return each year, the fixed index annuities are an option. And then you'd also have to ask the question, are they looking to get any kind of lifetime income? If they're looking to get any type of lifetime income, then the MIGAs wouldn't be a good option, and it would be the fixed index annuities with an income rider that would do that. So, it really depends on what the situation is and what they're trying to accomplish. I would just say it's important to ask those questions. If they, what their risk tolerance is, are they okay with a guaranteed 5% return? Do they want a little bit higher of a return? Do they want guaranteed income, or is it just straight accumulation? And the answers to those questions are going to really lead you to what product is going to be the best option.
Right. And like you had said before, Greg, you guys are happy to go over cases with our agents. So if you guys are out there and you do a fact finder with your client and you're still kind of floundering as to what you want to do, Greg and Mark are here to help with that. You can bring your cases and they'll help you go through it and determine what's.
Exactly. And I would just add to that, we are here to support you. So don't feel like if you're new to annuities, you have to know every single thing. You can always tell the client, hey, that's a great question. Let me check with my annuity team, and you can check with us, and we can help get you that answer. We'll train you, as much as we can. But there's always going to be something that, somebody asks that you're like, I'm not quite sure, let me check. But we're here to help you all the way through. And we actually, and I think Mark would agree, we really enjoy the case design option of it. So if you just give us kind of, the money they have, their age, the state they're in, and what their goal is, we can help case design that for you and tell you what the best product is.
Absolutely. Okay. That's all the questions that I see in our chat box. The agent said thank you for answering their questions.
Yeah, no problem.
Great presentation, guys. We really appreciate it. We appreciate you coming on here and helping to educate our agents. If anybody on the line is not currently contracted with Crowe or with Pinnacle, please reach out to us. We can get you guys set up to get started. And, like Greg said, if you aren't familiar with annuities, there's training available, and the guys are always here and willing to help. They really are a great team. And like they said, they'll help you out start to finish. So it's really, really great support. Thank you, Greg and Mark, for coming on with us. And we'll have to figure out what's next in our webinar series, but we'll
definitely have hopefully we could do the life insurance part 2 and then annuities part 2, hopefully maybe next month or so. So definitely looking forward to it, and certainly appreciate everybody that took the time to jump on the call today.
Yes, we do too. Everything has been recorded, and we'll be sending that out to everybody that registered for today's webinar. So you'll definitely have that information to be able to access and take a look at in the future. We always post all of our webinars to our YouTube channel. So please take a look out there for anything new. For anybody that doesn't know about the benefits of being contracted and appointed through Crowe, we have a $500 a month lead reimbursement program that we offer to our agents for Medicare products. And then, of course, the T65 seminar program that we also offer. We will help support you, through the whole process, as well as paying half of the vendor fee for your first seminar. So there's a lot of support to be had. If you have questions about it, you can just give us a call at the Crowe office. Lisa is in the office. She's the broker manager. Myself, Stephanie Taylor, I'm the sales director, and Teal is always there to help and assist with questions and concerns. So please reach out to us at any time. Thank you guys again for taking your time to be with us today. We've been trying to keep up with our weekly webinars, so take a look at the Crowe events page for what's coming up next week. And thanks again. I hope you guys have a wonderful day. Thank you, Mark. Thanks, Greg.
Thanks so much, everyone.
Have a good day.